Hey, what's up, stock compounders? Brad here. So Mohnish Pabrai hit us with another interview just a few days ago. This one dropped 2 days ago from Equity Master. And as always, I want to share my highlights. I got to start off by saying this guy has lived quite a life. He shared a story that I haven't heard before of meeting Michael Burry in 2008. So Pabrai was about to take a trip to San Jose, where Michael Burry had his office. So he just reached out to Michael Burry, said, hey, I'd like to grab coffee, fellow investor. They were both doing write-ups on Value Investors Club pretty early on, I think early 2000s. And I'm not going to tell the whole story. You should watch it and let Mohnish tell the story. But it's just so funny, him meeting Burry. There's no pleasantries. Burry dives right into CDSs, what's going to happen with the housing market. Basically, so Pabrai, the way he sees this, God loves him, right? God took the horse to the water, and the horse wouldn't drink. And of course, Pabrai has related this to multiple stories recently. But it's just so good that he was right there in October of 2008. I want to talk next about, he says, when you find yourself in the happy situation of the ownership of a fraction of a great business, just sit on your butt. He used a different word than butt, but the point here is be patient, right? Let that business make you rich by not trying to outsmart it, right? Jumping in and jumping out at the times that seem the most profitable. Own great businesses and let them ride. That's kind of where Pabrai is these days. That's his investment framework. He says, I have made many more selling mistakes than buying mistakes. So be extremely reluctant to sell. You must be convinced you have real signal to sell. Okay, there's some kind of deterioration in the business, a secular decline, and that it's not just noise, right? Markets are noisy, businesses are noisy. So it's difficult to really hone in on what are the couple things that really matter. And at what point does one or a couple of those things deteriorate to the point where the business can't recover? Okay, that's when it's time to cut your losses. I really like this question. He's asked, do you invest in anything other than stocks, right? Gold, real estate, debt. And Pabrai's answer, it wasn't surprising to me, but it's really hitting me deeply. And we're going to go a little bit into this with a LinkedIn article, with ChatGPT. It really brings up this Lollapalooza effect of auction-driven markets, right? The stock market is unique in some sense because it's an auction-driven market. And Pabrai is going to say more about that. He says there's one thing that's very unusual about the stock market, which does not exist in other markets. Stock markets are auction-driven. Auction-driven markets have a very specific peculiarity. They get depressed at times, and they get euphoric at times. The 52-week range on any stock is very wide. And I actually did a little exercise. I picked a U.S. stock at random. Okay, there's websites where you can do this. You could just say, give me a random stock from the U.S. So I did that, and I saw what the 52-week trading range was, and I normalized it. So it was X to 100. It turned out to be 62 to 100 for this stock I got at random from the U.S. So you've got about 38% there in terms of swing throughout the year. Now, I also looked at my neighbor's property on Zillow. I didn't do ours because we haven't lived here for a year yet, but I looked at the Zestimate for my neighbor's house. And the Zestimate range, I don't know if it's exactly like an accurate sense of what the price range has been over the last year, but the Zestimate range normalized on a 0 to 100 scale was 86 to 100. Okay, so that's a 14% kind of range versus this stock, which was 38%. Okay, so that just gives you a sense for the benefit of investing in an auction-driven arena like the stock market versus something like real estate. He says most assets are transacted between intelligent buyers and intelligent sellers. Okay. If I had offered to buy all of Racis for $25 million, they would have laughed me out of the office. Okay. So, that's just pointing out here. If you're trying to buy an asset, a whole asset, it's typically going to be two kind of intelligent people on either end. Whereas in auction-driven markets, they can get really wonky because of this Lollapalooza effect that we're going to get into in a moment. So he couldn't buy Racis outright for $25 million, but he could buy a third of the business at that price. Okay, at a third of that price. And that's exactly what happened. He says, this auction-driven market gives us a way to invest which is not available in all other asset classes. We have a mousetrap. We have auction-driven markets. We don't need to go hunting in less favorable pastures. Specialize in fishing where the fish are. Okay, so the stock market being an auction-driven market tripped a memory I had from this Charlie Munger Psychology of Human Misjudgment series, where Charlie brings up auction-driven markets. And, Charlie and Warren Buffett said, we don't participate in auctions, right? The simple solution is just to avoid them. Because we know there's this Lollapalooza effect of many psychological biases coming together to produce these wonky outcomes. Charlie says, it's just absolutely designed to manipulate people into idiotic behavior. And the insight I got listening to this Pabrai talk contrasted with this treatment of auction-driven, basically auctions in Poor Charlie's Almanac. I realized, actually, Warren, you do participate in auctions. You're just not the patsy at the poker table, right? You're taking the other side. So that was kind of a fun realization for me. And so, right, you can look at both sides, right? One side is this completely idiotic behavior. But if you can avoid that, if you can understand what leads to that idiotic behavior, you can be the beneficiary on the other side, which is exactly what Warren and Charlie have been for so many decades. But I just want to touch on a few of the psychological tendencies that are at play here. This reciprocation tendency, that surprised me, actually. But I understood when I read it. He said, at an auction, you may see a coffee cart offering free coffee before bidding begins. These are strategically placed, so when an auctioneer asks you to bid against yourself by declaring your bid of $10,000 is insufficient, you are obliged to increase it, right? Because you've received this gift, this cup of coffee. That's the little trick here. And it made me think of Robin Hood, right? The app that you can invest and trade on. I think when you sign up for Robinhood or when you refer people, they give you a free stock, right? And you get to scratch the thing off and you get this free stock. It's probably the same thing, okay? Reciprocation tendency. You get something for free, now you're even more invested in using that particular platform. So it's fascinating when you can unpack these different biases that are at play. You've got deprivation, super reaction syndrome. So I'm not going to go through all these guys. I will link to this LinkedIn article in the description. But it is, it's not that long. It's worth reading through. And then I asked ChatGPT, what psychological tendencies are at play in open outcry auctions that cause poor decisions? Okay, ChatGPT came up with 10. Social influence. Bidders may be swayed by the behavior of others, conforming to the group or imitating successful bidders. Can lead to overbidding or succumbing to herd mentality. So you get social influence, social proof, competitive arousal. The competitive nature of open outcry auctions can cause bidders to become emotionally invested in winning, leading to irrational bids that exceed the item's actual value. Loss aversion, anchoring bias, escalation of commitment, winner's curse. I haven't heard of that before. The winner of an auction often overpays due to competition and the aforementioned biases. This can lead to a sense of regret when the true value of the item is realized. Okay, so the winner's curse is you win, but then you're like, you kind of come back to rationality after the fact and regret it. Time pressure. The fast pace of open outcry auctions can make it difficult for bidders to accurately assess an item's value and make rational decisions. Overconfidence, information asymmetry, sunk cost fallacy. So these aren't all present in the stock market, but many of them are. And probably one of the best ways to improve as an investor is to really take stock of which of these biases and or tendencies are being drawn out by participating in the stock market. And then you can at least have awareness of when those things are at play, and we can hope to lessen their effect or even take advantage of them if we see them but others don't. So that's a little rabbit hole on auctions, which was brought up by Mr. Mohnish Pabrai. Okay, just to round out the summary of this talk by Mohnish, he's asked about what books he's been reading, what kinds of books. He says, a lot of books that I pick up to read, I don't finish. Okay, this is something I picked up from Naval Ravikant as well. They just don't appeal to me. A book has to draw me in the first 10 to 20 pages. Okay? And, it makes sense. There are so many books out there. Right? There's so many great books out there. Why waste your time reading a book that doesn't pull you in, that doesn't grab your curiosity in the first 15 minutes or so? Just move on to the next one. Okay? Forget the sunk cost, right? Maybe you bought the book, you've rented the book, you started it. No. If it doesn't grab you, put it down, return it, just get rid of it. Move on to the next one. Pabrai says, investing is a very broad discipline. Understanding humans, human psychology, nuances of what type of business is likely to do well. All knowledge is cumulative. Basically, here he's saying, read broadly. Read whatever interests you, whatever grabs your curiosity. There's no formula, right? It's not like you read the top 100 investing books and you're automatically a great investor. No, this is a game of pursuing your curiosity, building your knowledge about how the world works. He says all knowledge is cumulative. And he's pointed to that in the past as the great advantage that we have as investors over, say, an NBA player like LeBron James. Knowledge is cumulative, so we just get better and better and better, until we get so old that there's decline there that happens to everyone. But clearly physical decline, as in an athlete, happens much earlier in life than mental decline. So we can just keep getting better year after year if we remain curious, if we continue reading and learning about how the world works, learning from other great investors, learning from the greatest entrepreneurs, business builders that have ever roamed the earth. So back to this, all knowledge is cumulative. The most important objective in reading is that I have to be having fun. Okay? So don't force yourself to read something. Check in with yourself. Am I having fun? Is this interesting to me? If it's not, move on. Pabrai says, financially, I could have retired at 33. Okay, he had enough money at 33 years old to never have to work again. Okay, so if it's not fun, why do it? Right? That's obviously a great position to be in. But each of us, I think, could probably have a little bit more, demand a little bit more of that in our lives. He says, I'm very biased towards business biographies. That tends to be what grabs Pabrai's interest, learning from incredible entrepreneurs of the past and present. So that's it, guys. Definitely listen to his story about meeting Michael Burry. It is just so funny and kind of surreal, right? The timing was just so perfect, and that he totally missed it because, he doesn't know anything about CDSs. It's clearly out of his circle of competence, but just so interesting. And yeah, just thinking about this stock market as an auction-driven market and how, Buffett, Munger, avoid them at all costs. And yet that's how they really made their money, by participating in this auction-driven market and, not making the mistakes, or making a lot fewer mistakes than most other market participants, right? Understanding where are the follies, right? Where's the poor judgment? How do we avoid that? So anyway, guys, thanks for watching. Big shout out to Mohnish for, dropping a few of these talks in a row. It's always fun to kind of do this marathon style. And I will see you all in the next one. Take care.